Yeah, so our dog of the week is TFI International, symbol TFII on the TSX as well as the New York Stock Exchange. It is a North American leader in the transportation and logistics industry. The company operates across Canada, the US, and Mexico, serving less than a truckload, and logistic segments. The stock has fallen 30% over the past week to about $127 or a 10.8 billion market cap Canadian. This is just a sharp decline after really years of consistent share price appreciation. You can see there on the left, quite consistent, very few significant drops really since the pandemic. So this is the biggest, I think, percentage drop since then. I think the last one, it was about a 20% drop in that 2022, if you see there. So what has really changed this week? The company reported its Q4 2024 earnings. For Q4, revenue before fuel surcharge was up 9.1% to $1.83 billion due to acquisitions done in 2024. They're a serial acquirer. Lots of them are tuck-ins and smaller, but they do consistently do acquisitions, and that is why revenue was up. But operating income was down 19.2% to $160 million. Adjusted EBITDA down 1.7% to $315 million. Adjusted net income was down 30.7% to $102 million, or $1.19 per diluted share. Just generally weak earnings, to say the least. It was not a good quarter across the entire metrics. Every single one was effectively down. Even when you're looking at more operational metrics, which I do not have up here at the moment, effectively everyone was disappointing. So what was this reason for this overall weakness? Margins for all the segments were down significantly, with aggregate operating margin down 8.8% from 11.8%. Even though the absolute figures for truckload increased due to acquisitions, margins compressed due to just low volumes. Volumes fell, but shipment weight remained the same. For the US less than a truckload, shipment count actually fell by 6%, which is significant for any shipping company. Notably, the company highlighted weaknesses in the small to medium-sized customers, which tend to have higher margins than the corporate or third-party logistic accounts. So you're losing your high-margin accounts and replacing them with lower-margin accounts and having overall lower volumes. It's not a great scenario. So lower demand has really been seen across the market as well, not just TFI. I'll make that very clear. This is a freight issue as a whole. The market is overall weak. Freight volumes internationally have been weak. It is a cyclical market, and you are seeing both a weaker pricing environment and lower volumes, making it a tough environment for any company in the industry to really operate in. Within the company called out T-Force, though, a company they acquired in 2021, being a significant drag on the company with a poor operating ratio of 97%. Effectively, operating expenses are 97% of the revenue they bring in. The company is trying to make some moves despite the really awful environment to operate in. The company may look to conduct some further acquisitions. The CEO was saying they need to be bold, which it has continuously done over the year. They've done many, many acquisitions, which I have up here. You'll see double-digit acquisition count for the past 5 years. So they are an acquisitive company, to say the least, but they do need to mind their balance sheet. Its debt to EBITDA is 2.1 times. It's not absurdly high, but if you do start to see EBITDA drop, that can get out of control quick if you really do see a very, very weak freight market for extended periods of times. Whether that happens or not, I don't know. And the CEO himself has been repetitively said in the conference call, it's foggy and it's just not a clear marketplace in general as a whole. But the company is looking to reduce debt during 2025 by about $500 million, which may open up some further room for being opportunistic in a down market, which is always good to see when a company does have the balance sheet room and the capacity to be acquisitive and buy companies at cheap prices. That can be great down the line. But it's really very difficult at this time due to the downward trend of the industry. Ryan has previously actually stated in Your Stock Our Take the company may be interesting on a 10 to 20% pullback, which this would actually be well surpassed that. We're looking at 30% here. But the weakening demand does really require a discount, which is the question, is this enough of a discount now that we're in a really cyclically down market? So echo what the CEO said during the conference call multiple times, the outlook is foggy. So I would expect higher volatility in the stock price over the next year, especially when earnings come out. You're going to probably see very big shifts up or down as this foggy scenario doesn't clear up. And then further, of course, there's things like in the US, even though they don't do many, I think it's under 5% of cross-border shipments, you have the tariff scenario. If the US economy does weaken, what is going to happen there. Obviously, if the U.S. economy does weaken, you have less shipping, you have less any transportation. So will that actually impact the company if we do see a U.S. economy, which has, even in this weakened shipping environment, the U.S. economy has generally remained quite resilient, especially compared to other economies around the world. So that is really what you'll want to be watching for TFI going forward, is can the entire industry start to really pull itself up, and do the market conditions improve as a whole? And as well, then on the TFI side, can they navigate it? Can they make an opportunity out of this really poor environment? Are they able to hit the right acquisitions? Because, like I was saying before, their 2021 acquisition of T-Force hasn't gone so great. So you really want to see those companies actually push forward and not just make poor acquisitions, because you can't make bad acquisitions even at cheap prices. But for now, it is our dog of the week.
Yeah, well done. One thing that I would like to mention as well is, like, we ended up interviewing Titanium Transportation Group, TTNM, on the TSX back in like September of last year. So not too long ago. And again, we were kind of getting the same thing from them. Like, they're talking like exactly just what Brett said: weaker pricing environment and demand. And here's a little segment of my notes here. So these are just taking notes in that meeting. In 2023, pricing was strong. People were getting money and buying tons of products. And everyone and their neighbor was buying a truck and getting their truck driver's license. They went from having not enough trucks and too many loads to too many trucks and not enough loads. 2024 was really the accumulation of this, and they had so much overcapacity in 2023. But now getting beat up in 2024. There are certainly headwinds given the pricing environment. There is a tailspin in the industry of overcapacity, but the management of this company was saying that they think the tailspin will be over quickly. Who knows? But it really puts it into perspective.
Yeah, and titanium has been cut in half
Yeah.
basically since May, April of last year in terms of its share price. So
Mm-hmm.
for me, I'd love to see, Brett was saying, the company pay down some debt. The weak demand would have me revise lower any entry point in this company. I would rather see, we need either a massive discount in this fog that we're seeing here, to quote the CEO. I'd rather wait until we see debt pay downs and a turn in the numbers before uh, uh, before considering buying right now.
Mm-hmm.
And that's really
it's been a good long-term company. It has had a good trajectory, but that is turning, it looks like, in the near term. And with debt higher, share price higher, or share count higher, we want to kind of stay on the sidelines until we see, pay down some debt. And then if we see, potentially more or just better economic activity, like this is a company that has executed well in the past.
Yeah. And that's the problem with these cyclical companies, is sometimes when they're looking the greatest is the worst time to buy. And when they're looking the worst, they're the best time to buy.
Yeah. So if you're going to look at that, find a really good company, like say, identify that TFII is a great company, and then, buy it when it looks ugliest, potentially. That is not the strategy we use, but it is, something that you could look at if you are looking at a company like that.
Assuming, of course, that ugliness and that risk is reflected in the valuation, because sometimes is the financial picture is not great, but the valuation still does not include all of that risk.
That would just be a lot of ugly, too much ugly there. Yeah, you want ugly and the numbers start looking good. Yeah, for sure.